Obviously, we're in a period of volatility, really centered around the U.S. tariff policy and the changes to that policy. Not only the rates and amounts, are they on, are they off? And obviously that uncertainty really creates a little bit of chaos for business owners. They can't make plans, can't make investment decisions. So you start to create, that uncertainty creates a sense of slowdown for things, right? Which starts to feed into the economy, which creates volatility for both equities as well as fixed income, frankly. We had gone basically to neutral on equities earlier in the year on the idea that some of this upcoming tariff and policy uncertainty would create some kind of dislocation. Obviously, we now are feeling the effects of that. Within the equity bucket, we remain slightly overweight the U.S., overweight Japan, remaining more underweight the rest of the world, particularly the emerging market world now, which is going to be obviously front and center in some of the tariff issues that we're now seeing. This uncertainty is creating a bit of economic slowdown, or certainly a fear of an economic slowdown. If you think about that, part one of that would be if small businesses, big businesses start to fear a recession, you can see credit start to widen out, in which we're starting to take that overweight we've had to high yield down. At the same time, emerging markets, which we have favored on the fixed income side, also kind of front and center in the tariff narrative, started to bring that weight down. As well as on the sovereign side, we've been underweight for quite some time. So that leads us to a greater underweight in fixed income and now sitting more in cash than we have in a while. Adding to that cash position, which I just mentioned, our equity hedge has been turned on. And that'll give us, again, some buffering to the volatility as we trade through this range that we're now in.